Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with my 40th guest, Paul Whiteley. Paul, go ahead and tell the people a little bit about yourself.
Thanks, Troy. Great to meet you, be on your show. So I'm Paul. I live up in Toronto, Canada. I work as a project manager in the healthcare sector, and I've spent, originally, you can probably tell from my accent, I came from the UK, and I've been in Canada for probably around 25 years now.
Wow. What was the draw from the UK to Canada?
The draw was, I just felt like a change. My career had pretty much done pretty well. I worked for General Motors, and then I came over here just because I wanted to try to experience something new. I was 26 when I moved, and everything I heard about Canada was great. Great cities, great people, great place to live. Just had a very good global reputation. And then when I came here, I found Toronto is a very multicultural city. And yeah, I don't regret the move at all.
Was there anything from your move to the UK to Canada, like hyped up Canada, and you're like, it's not really like that. It's not that great?
I would say the biggest thing was the winters. It's described, when I was in the UK, it was literally described as for 6 months, Canada completely shuts down. There's polar bears wandering around, there's snow and ice everywhere. And then I realized that was only way in the far north of the country and down in the cities. It's actually 4 seasons of the year. It's not this blanket of ice.
Yeah.
It was a little different.
It is funny because I moved, like I was telling you pre-interview, I moved from Pennsylvania to Oklahoma. And when my dad came out to visit in 2021, for whatever reason, people think Oklahoma just never like progressed. Like it just stayed still. So like he was surprised to see like cars in grocery stores. And I'm like, we're not like in the 1800s. Like we have things. So it's funny to hear like when you, I don't know, it's just the thing that goes in people's heads where you just think the different parts of the world are just so much different. And in some cases they are, but in other cases you're just like, why? Like we still progress. Like what are we doing?
Yeah, I was definitely disappointed when I came to Toronto. I didn't see a grizzly bear wandering down the street, for example.
Yeah, what the heck? It's real disappointing. So, all right. So my first question for you is, when did you begin investing? And then what got you into the dividend side specifically? Because like a lot of people don't start with dividends. So did you start with dividends or did you wander into them somehow?
So the first investing that I did, the town that I lived in the UK had a very large, basically bank, one of the biggest banks in the world. And I did a little internship there as out of high school. And as part of that process, I bought stocks in that company. I bought one stock in my local, they call it a building society in the UK, but it's the equivalent of basically a big bank. It was a dividend paying stock and I held it pretty much for 25, 30 years.
You don't still have it?
No, I no longer have it because the bank got taken over, but I own the parent bank that has now taken it over. So they were basically taken over by Barclays Bank, which is obviously fairly globally known. So I still own that. So my first dividend stock, in theory, I've owned it now for over 30 years.
So is your cost basis on that like 17 cents or something?
My cost base for that would be, I think it was about £1. So my yield on cost is probably looking at around 700%.
That's not too shabby. Yeah. That's one of those things where like when you see like Warren Buffett, when he gets paid like 3 times his original investment in dividends every quarter, you're just like, how's that happen? You hold it for 30 years. That's how it happens. So that's pretty cool. Yeah, I like that. So did you, when you first bought that bank, the equivalent of a bank stock, I'm assuming you didn't buy it because of the dividend, right? You bought it because that's where you were working at the time. And then like, how long did it take before you started seeing this thing called a dividend come through? And like, did a light bulb go off? Like, wait a minute, they're just paying me money to hold this thing.
So the first thing was about 10 weeks after I first bought it. A little lump of cash went into my investment account the dividend had landed. I didn't really know what it was at the time. I thought it was just kind of interest that I was getting paid, similar to a bank account. And that's when the light bulb went on, that every quarter now money is just landing in my account for doing absolutely nothing. So that's where it all started.
Yeah.
It was the concept of seeing money land in my account for doing nothing, and that is what got me addicted at a very young age.
Like what, 30 years ago you said?
Yes.
Yeah.
So I've been at this for quite a long time. I've had good parts, bad parts, and everything in between.
Well, that's what we're about to find out today. So hopefully you don't hold no secrets on us. We want to hear it all. So, okay. Well, actually, good segue. So the next question I have for you is, what would you identify as your biggest dividend-related mistake? And more importantly than the mistake you made is, what lesson did you learn from making that mistake?
So my biggest dividend-related mistake was probably chasing companies that had too high a yield and not fully understanding how the dividend was funded. So when I was starting out, I definitely didn't pay attention to payout ratios. I just saw it as, if they're paying this money out as a dividend, the company's already done the analysis behind the scenes to say, yeah, we've got enough money in the coffers to keep paying this out and keep it paying it out at the same level. So the first time that I had a dividend cut and the share price plummeted because they didn't have the earnings to support it, that was a massive lesson that I learned. So now when I invest, I always check, does the dividend payout ratio seem reasonable? Is it within a fairly good range? So I'm a lot more careful now about what is the risk of a dividend cut.
Yeah. Have you had dividend cuts in your portfolio?
Absolutely. I've had recently, there's a company I invested in, it was a healthcare provider, Northwest Health it was called. They literally took their dividend and slashed it in half first, and then they cut it completely just because they didn't have the cash flow to cover it. And not only do you get hit from the cash flow side, you have the added bonus or negative, however you want to describe it, of the stock price itself. I think it lost like 60% of its value pretty much overnight just on the announcement of a dividend cut. So that's something now that I'm a lot more cognizant and careful about.
Yeah. Okay. So 2 questions on that is, one, so how do you handle a dividend? Because I've had companies in my lifetime that I've owned that have cut their dividend, but I've never owned a company during a dividend cut. So how do you handle that? Like, if a company that you own cuts a dividend, is it immediate sell, or do you reevaluate and try to figure out, like, are they in a better financial position now that I can keep holding them, or how do you handle that?
Same way I handle all my stocks. So I'm always looking to, do I think this stock is reasonably priced based on its earning potential and its growth potential? So it doesn't matter if a stock has cut its dividend or not. I'm still going to analyze it using those same 2 criteria. So usually when a stock has cut its dividend, I'm probably likely to keep it, and there's a good chance I'm going to buy more. Because at that point in time, it's now probably hit a point where its payout ratio is probably lower than the target payout ratio because they've made the dividend cut. The stock's probably fallen in value 30-40%, so it's probably a buying opportunity. So yeah, I'm definitely, I mean, there might be rare exceptions where I just think the company's going completely down the toilet, and then I'm going to maybe get out entirely. But most of the time it would be, this is an opportunity to buy more.
Okay. And then when you were mentioning before about like so the yield is what most people on the show say, is that at some point in their journey, they've chased yield. And at some point or the other, they end up getting burnt because they're like, oh, why would I put, $1,000 into this company that's got a 2% yield when I can put $1,000 into this company that's got a 10% yield? Like, that's definitely the better investment. That's not always the case. So, and it's not, again, on the flip side, to argue with myself, it's not always the case where the company with the higher yield's a worse investment than the one with the lower yield. It doesn't always work like that either. But my question for you is, when you said that you look at the payout ratio, is there a sweet spot payout ratio that you like to be in? And then is there one where it starts to raise some red flags on your end? Like, hey, I really don't like them above this percentage.
So if they're a fairly mature company that's been around for a long time, their business model's fairly stable. Like I'll use like mature banks, for example, around 60%, I think, is a nice payout ratio. If it goes, I would say if it starts going to 70 and above, then I'm thinking this is probably too high. It's unsustainable. So 60 is around my nice ball. But if it's more of a company that I still think's got potential for growth, it's growing, it's investing, it's getting bigger all the time, So that level of its maturity journey, then I'd be looking for them. I would want them paying out less than half as a payout ratio because I want to see more money going back into the business.
Mm-hmm.
So anywhere between, I would say, 45 and 60, I would say is my nice sweet spot to get in.
Okay. And do you believe that it's one of those situations where, like, in every case, the lower the payout ratio, the better? Like, if you found a company that was really mature, or a company that was in like super growth mode and both of their payout ratios were 8%, would you be like, that's not a red flag for you, right?
Um, it's a little bit of a red flag. Let's take an example, say like an Apple
Mm-hmm.
or an Amazon. If they suddenly started paying out a 50, 60% payout ratio, because Apple and Amazon, their dividend is relatively small, like because they're still
Well, so
growing.
Amazon doesn't pay, but Apple does. And so Apple and
Yes.
Microsoft both pay, and both of their payout ratios are very low.
Yeah. So, for example, if companies like that suddenly started having a fairly big payout ratio, I would get concerned because then
Yeah.
I'd be thinking, well, you're a growth company still, you're expanding into all these different industries and markets. Why have you suddenly switched your strategy from that into more returning more capital to shareholders?
Yeah.
So then I would do a deeper delve into what exactly is going on with this organization. Why is its strategy suddenly changing?
Okay, so this is a question, like none of these are scripted, this part of the question. So like the question I'm wondering is, with the implementation of AI, and how, I think it's going to make things cheaper for companies to do. So therefore companies might not need to spend as much time, money, and resources on research and development if they can get AI to do things for them. Could you see payout ratios of growth companies going up because now companies are increasing their margins perhaps, and now they can possibly say, hey, we have even more money to just because you market something doesn't mean, it's going to keep getting more valuable. So now they're like, hey, we have even more money that we don't really have anything to quote unquote do with, and now we can pay it back to the shareholders. Do you think that's a thing that could happen in the next 5 years?
Oh, that's an absolutely yes for definite. It could happen, and that's why I mentioned that if I see something like that, that's my trigger to go in and look at what exactly is going on in this company. Mm-hmm. In that example you gave, if it's like an Apple or a Microsoft, sure, they may have launched it, but then if I read that they're basically now they've got more efficiencies because they're using AI a lot more to do development, whatever, that's a good rationale as to why now you've got more money and cash flow to give out as dividend. As long as I can understand where this extra cash flow is suddenly coming from, mm-hmm. I'm fine with it. So that's a perfect, I think AI is going to change things dramatically, but at the exact same time, I fear that there's going to be a lot of legislation coming in to get it under control. I don't know what it's like, from what I've observed, certainly in the industries I work in, AI has the potential to replace literally hundreds of thousands of jobs. Mm-hmm. And is government prepared to allow that to happen? I'm not convinced they are.
No, like I'm not, I'm the furthest thing from political, and I try not to be at all on this channel either. But like my thing is, things have happened, like the printing press was invented, and that, everybody was like, oh, what are the writers going to do? Like people learn to adapt with things. That's how the economy should work, is like, we let the things happen. People invent new things that make things easier, and then people's jobs will change and adapt with those things that are invented. So I think we just need to let it go, let it do its thing, and we'll figure out how we can best utilize that thing. If it's us working 30 hours a week because we don't need to work 40 because now everybody's more productive, maybe that's what it is. I don't know. But like, I share the same concern you do of like people that don't really understand the technology jumping in the way and halting progress, or trying to put in some kind of rules and regulations that make it hard to like see where it actually goes. I'm a little fearful of that as well.
Let me reframe my concern a little. So my concern is not necessarily how the industry will change. My concern is, will some kind of regulation go in that will ultimately impact the cash flow of the company that I've invested in and change its complete strategy for the payout ratio it makes, for profit it makes? That's what I'm concerned about. I realize there's a bigger social picture about jobs and whatever, but I'm looking at it purely from how will this impact the investments I have made in that particular company?
Yeah. And that's something that like, it's really hard to wrap your head around regardless, because like we don't know good, bad, or indifferent. Like if it has no impact, huge impact, small impact, we have no idea. So it's kind of like a wait and see, and hopefully you can react accordingly when the time comes, I guess. So okay, so the next question for you is, I'm curious, because you've been investing for the better part of 30 years, how, if at all, has your investing style changed from when you first began to now? Like, how's it adapted and molded over the years?
Um, the biggest thing it's adapted, I would say, it was very, very conservative at the start. So when I first started, I was very averse to losing money. If I saw my stocks go down, it was like, oh, this is panic. Have I done the right thing? I might have made a mistake. As I've grown older or more experienced, I've learned now just to take the rough with the smooth. And now I see a decline in my portfolio as a buying opportunity. I'm a lot more savvy of seeing things in the market now and seizing on opportunity. So if something happens, such as a COVID, where suddenly the whole stock market collapses, I now see that as I need to get everything I can get my hands on and go all in. Whereas 20 years ago, I say, oh no, the entire stock market's collapsed. I need to find a way to protect what money I have and make sure it does good. So that's the biggest difference that I've made. I've now become I'm now a lot more focused on market conditions to make big investing decisions. Whereas before it was, I'll just go with the flow and I go along with the ride.
Isn't it weird how that's almost like the opposite of how we should invest in theory? Because like, I've heard thousands of times, when you're young is when you take the risk because you have more time to like get the money back. Like if I lose $1,000 when I'm 18, like who cares? Like you're not by the time you're 65, you don't even remember that you lost $1,000. One, because your memory's gone, and then two, because it was like $1,000 back then. Who cares? But then like they say, as you get, I mean, I don't know if you guys have like things that are called like target date funds and like a retirement account. Yeah. So like when even looking at the structure of those, the closer you get to that retirement date that your retirement year you're selecting, the less and less risky your portfolio gets. So even those are still programmed the same way. And it's not even that you're being more risky now versus what you used to be. You just switch the mindset of basically like, back in the day when you first started, you were in, hey, I like to make money, but I'm more afraid to lose money.
Yes.
And now you're in the mindset of like, I am still afraid to lose money, but I'm more excited to make money.
I would say overall, I would say I'm a balance between the two.
Okay.
But the difference is I have a lot more knowledge now and confidence.
Yeah.
So now when I see an opportunity, I now realize this is an opportunity. This is an opportunity to multiply some gains. Whereas before, I didn't have enough knowledge to realize the opportunity that was coming up. So I would just let it slide.
Yeah. Well, I mean, it is scary. Like when you try to do it, like in the, I don't know, the U.S. markets, like the last, I don't know, 2-3 weeks have been kind of not doing fantastic. And it is hard when you see something, one of your positions down 2, 3, 4, 5% in a day, and it just like, here's more money. Like a lot of people are like, wait a minute, like what's going on? Like, why am I losing money? And like, I think that is, I often refer to it as like the emotions of the stock market, as far as your emotions towards the stock market. That's the thing that like, as you get more experience and more wisdom in the stock market, I think that's the thing we really successful investors really hone in on, is the emotions of the stock market, where they can say, hey, I know that I've lost, 1, 2, 3% of my portfolio today, but now's a good time. I was going to buy these stocks I'm going to buy today. I was going to buy them whether it was a green or a red day. And I think that does take some skill to do. And, it happens at faster paces for some people and slower paces than others. But I do think that's one thing that can make you a successful investor, is being able to separate those two things, not worry about where the portfolio is sitting today, realize you want more shares of something later on. The only way you can do that is to buy them. So,
well, I find the 1 or 2% interesting as well. So that's something that I've learned as I've matured as well. It's now, even if my portfolio fell by 20%, I'd probably be whatever, because I know it's well diversified. And as long as my core holdings are still able to produce their dividends and income and whatever, I'm perfectly fine with it. Whereas 20 years ago, if somebody says your portfolio is going to fall 20% in, say, a 2 or 3 week period, I would be completely freaking out and running for the exits. Whereas now it's just like, whatever.
Yeah. Yeah. Where's the opportunity? Yeah. What else can I buy? Yeah. I like that. Okay, so I'm curious. I want to know your answer on this. So, do you have any short term goals for your portfolio? Let's just say for the rest of 2024, and then what are some of your long term goals for your portfolio? Do you hope to retire off of this? Is it just going to be a supplemental source of income? What are your plans?
Oh no, my overall long-term goal, and because I'm a little bit older, I'm getting close to it, is to basically take what I was earning in salary in my regular job and have that entire income coming in dividends instead.
Mm-hmm.
That's my ultimate goal. Um, in terms of my short-term goals are pretty much keep my portfolio as it is. Like,
Mm-hmm.
I'm pretty happy. I don't make a whole bunch of trades in my portfolio. Once I've set it up, I tend to stick the course and go with it. So I don't have specific what I would say is short-term goals. My biggest one is to, and I'm constantly working on this, is to tax optimize my portfolio.
Mm-hmm.
Which accounts do I need to use so I pay as low tax as possible, and think about how I'm potentially going to move some of my more growthy style stocks into income producing stocks.
Mm-hmm. So is that do you have just growth companies and then just dividend companies, or do you have a mix of like what we call dividend growth companies, like that the Facebook group we're in, where it's like, hey, this company right now, the dividend's here, but if I hold this for long enough, this could be not only my growth company, but also my income producing company, and I never need to sell it. How do you handle that?
So I would say I have a small percentage of what you just described as dividend growth companies.
Mm-hmm.
I would say I've got probably around 50% of my overall portfolio in solid dividend income stocks. Let's say 48% more in growth style stocks, and maybe 1 or 2% in that little sliver in the middle that you've just described.
So have those percentages changed over the years too? Like when you first started, were you 80% growth stocks and 20% dividend stocks, or how'd that work?
So when I first started, I wasn't even in individual stocks at all. I was just in ETFs,
Yeah.
apart from that one company that I knew very well. Um, and I would say it switched. The pandemic switched everything for me, to be honest. When the pandemic hit, so I was in growth mode all the way through, and then when the pandemic hit, that to me was a once in a lifetime generational opportunity to change your portfolio entirely. I basically went all in. And then once the markets came back, I moved out of what I would class as growth and into income, because now my base portfolio level is a lot higher.
Yeah.
So I so it has switched, but again, it switches based on market conditions as opposed to my age.
Okay. And then how are you so you mentioned that you were in the process of like slowly transitioning into more of the income as you get closer to your goal of retirement. So how are you handling that? Is that the process of selling off those growth companies and putting them into more income, or is that just like no longer buying the growth companies and any new money is going into income, or how do you handle that?
I would say overall I have a balanced investing style, so I like to allocate funds into both income and the growth side. But once if growth stocks do well and they get outsized in my portfolio, then I will sell some off and I'll put it into the income side. On the income side, because I don't need my dividends for income at this point in time, because I've got a regular job, all of that's just being reinvested,
Mm-hmm.
and it's just adding to the overall dividend pot.
So when you say reinvested, are you doing the drip, like where you're just letting the same company invest in it, or are you putting it all in a pool and then trying to identify opportunities based off of that cash you have?
I would say maybe there's a small handful of companies which I'm pretty solid. I'm happy to buy more, so I've got drips with those. But I would say that's maybe 20% of my portfolio, but 80% of it, I just let it get into a pool. Usually, I wait until say $2,000 or $3,000 is built up, and then I'll go and buy whichever equity I feel is a good stock to buy. It's typically something that I already own, and I'll just add to my position. But yeah, I do like to pool money up and then see where is the best opportunity.
Okay. And then how do you determine which which companies that you do that drip with versus the ones where you just collect the money and you invest it how you see fit?
Comes back to kind of what we talked about at the start. It's the companies that I feel have a solid payout ratio. They're growing at a reasonable rate. Their balance sheets look strong. So I've got full confidence. I know these organizations well. I like their business model. I like the direction that they're going. I'll just drip, but I don't even need to look at it. So it's more the companies that I don't know as much about. Those are the ones where I make more conscious decisions of should I invest more money in this company or not.
Okay. So your highest conviction ones are the ones that basically if you were to pull the money, you would likely put money back into that stock anyway. So you just let the drip do it anyway. Okay.
Yeah.
I got you. Okay. So you did mention that you are like sometimes if your growth portion of your portfolio gets outsized, you like to trim some of those gains. So with that, do you have any stocks that you perhaps regret selling, like regret trimming? And then on this flip side, do you have any stocks that you identified at a very, very low price, very good evaluation, stuff like that, that you can brag about, like ones that you're excited that you bought?
Well, I certainly trimmed, in retrospect, probably Nvidia a little early.
Hey, they just dropped 10%. You missed out on it, so you're welcome. Good job.
They did. I mean, I've been in and out of Amazon over the years, and I've probably sold that a little early at times as well. So I would say the big US tech companies, because they have such swings to them, it's difficult to tell overall. So, but I don't regard it as a regret because I take the funds and I invest in something else.
Yep.
Like anyone can look back in hindsight. So I feel I did very well on the cannabis stocks up in Canada when they decriminalized cannabis. All our cannabis companies exploded, and I thought there's no earnings to support all of this. So I got in and out of those pretty well. In terms of so what was the second part of your question?
So it was selling regrets and buying brag. So like companies that you identified at a really low price that maybe you got on the train early. Like maybe you bought Nvidia at $10 a share and now you're rich.
The best stock I actually bought was a company called TAL Education Group. It trades on the US stock exchange. They're basically a private tutoring company based in China and Hong Kong. And they set up a model to allow private tutoring of students. And it was originally designed for, I guess, rich families who wanted to give their kids an extra advantage. But when all the schools closed down for COVID, everybody was going to this platform for online tutoring. And that's when that stock completely exploded. So that was probably the best stock that I've ever bought. That actually, I got a recommendation for that. I only found out about it because it was in one of our national newspapers. There was a columnist who wrote about it. He said, maybe take a look at this. I read the background of it. I thought, this sounds like an interesting company. Like never in my wildest dreams did I think I would invest in a private education company in China. Like that's so far away from my radar.
Yeah.
But then I read the other, I thought this is a good business. So that would probably be my biggest brag company, I would say.
That's pretty cool. And is it still doing well, like post-COVID recovery stuff? Like, is it still doing good, or is that one that you trimmed?
I have no idea. So I sold out of it completely once I got to a pretty substantial position. One of the things I tend to do, and this is something I've learned over the years as well, once I make the decision to sell an equity, I don't go back and revisit it.
Okay.
I don't go back to say 6 months, oh, maybe I made a mistake, because I don't think any good can come of it.
Yeah.
If it comes onto my radar as something as, or maybe I'll look into investing in this again. So I couldn't even, for all, TAL it could have gone bankrupt. It could be worth $1,000 billion. I literally have no idea what the value of that company is now.
I mean, that's probably healthy that you do that. The only, I like that, and I might actually steal that for my own portfolio. The only thing is, like, and we'll get into this later on, I actually have like set filters and criteria that I use. So when I do that, a lot of companies that I used to own will sometimes come back up on those, and I'm like, son of a, like now I have to see this thing again. So that's happened to me a couple times, but I do like that strategy of yours because, like you said, nothing good's going to come out of it. One thing I like to say all the time is like, try not to beat yourself up over like information you have today over a decision you made years ago. Like you can't be mad at yourself for, like, for me, my situation is I sold Nvidia. I bought Costco with that money. I sold Nvidia. I was up 55%, but I sold it at like, I don't know, it was like 330 or something that I sold it at. Now it's at 800. So like, obviously I missed out on a lot of gains, but like, I didn't know it was going to be 800. Obviously, if I would have, I wouldn't have sold it, but I can't say, oh, now that it's 800, that was a bad decision. It could have easily been 100 and I made a great decision. And there's no difference on my head from what I knew at the time to beat myself up about that. So I do like that philosophy that you have. That's a pretty good idea. I like that. Okay, so next one for you. So so this is kind of like a multi-pronged, multifaceted question. So like, do you have any recent dividend milestones or achievements that you've recently achieved with your portfolio? And if you do, what role do these little milestones and achievements play in help keeping you motivated because of how long the dividend game is?
So I'm constantly focused by little dividend milestones, I would say. It's like I had an initial dividend milestone of like $100 a month. Then it goes up to 500, 1,000, 2, 5. So I've got overall dividend milestones for sure in terms of my overall portfolio. One of the things I did, and I kind of touched on this, is when COVID hit, I actually took out a line of credit and I went all in on dividend stocks. So to me, a big milestone was, are my dividends not only covering the interest on my loan, but allowing me to pay it down as well? That was a big milestone. To me, I would say the most significant milestone, if you're wanting a dollar number, was $5,000 a month for some reason. Sent like a very, when dividends hit that, I thought that's a pretty cool round number to be getting from an income portfolio.
I mean, I was told there'd be no math, but that's what, 60,000 a year?
Yes.
Yeah, I mean, that's like, I think the average or the median income in the United States right now is like 53,000. So I mean, that's basically what you're saying, is that like at that point you were making more than the median United States. I know you're not in the United States, but you're making more than United States median income passively. And I that is a really cool milestone. Honestly, it's those same arbitrary numbers that everybody uses for everything. Like once you get your first, like for me, it was like, okay, I got my first dollar, like my first whole dollar. I remember when I was getting paid and it was, everything was in cents. Then I was like, oh my gosh, I hit $1. Then it's like, oh, now I'm getting $10. Then it was $100 or $50. And then same thing. It goes up like you're talking about monthly, where it's like, oh, I made $100. Oh, this is my first $200 month, and so on and so forth. So, so follow-up question on that is, what, do you remember how long it took, or do you remember maybe even a specific time period when you actually looked down and like started to notice the dividend snowball that everybody talks about, where you're just like, hey, this thing's really moving now. Like I'm going to actually make some progress?
I would say once my monthly dividend income got to around 400 or 500. And as I say, I'm putting some of it in drips, some of it I'm just pooling and reinvesting. That was the point I would say that, wow, this is really making progress now. Because I don't know how much most people are saving, but for most people that I know, just to be able to put $500 from your paycheck into a savings account each month is a big deal. So to see $500 coming from dividends that I could reinvest, to me, that was the point of, I thought, this is a strategy that's working for sure.
Yeah, at that point, it's almost like there's two people contributing to your portfolio.
Yes.
Like you have you and your dividends that are now you're tag team and it's always like that. But like when the dividends are adding, $6.46 a month and you're adding 500, you're like, okay, well, you're not holding up your end of the deal. And then eventually it's going to get to and this might be where you're at now, is where your dividends per month are adding more to your portfolio than you are. So it's almost like you're the one getting carried by your portfolio now. And it's like, okay, now my dividends are bringing in, $4,000 or $5,000 a month that I'm adding to the portfolio. And I'm only adding $2,000 a month. So not you're still working together, but like, that's a cool place to get to. I don't know if you're there yet, but like, that's a cool place to get to.
Well, when we were talking about milestones before, that what you just described, I would say is a hugely significant milestone.
Yeah.
When you hit that, so I haven't gone past that point. So when you hit the point of there's more money being reinvested from dividends than I'm actually putting in myself, that is a cool feeling for sure.
Yeah,
I would say.
I'm excited for that. I'm excited for you for that, and I'm excited for me to eventually get there too. So And if this is too personal, just let me know. But like, do you remember like how long did it take for that to happen for you? From what, like, do you remember like a roughly amount around the time when your dividends passed what you were contributing?
I would say I'd probably been investing for around 15 years at that point.
That's not too bad for like, and the cool thing about that is that now in theory, it's going to be from year 15 on. You're not going to like, you can make it a game with yourself where you're going to try to contribute the same amount as your dividends and you'd probably go broke.
Oh, for sure.
Yeah.
I mean, the best thing that I see it of, even if I didn't contribute any extra money at all to my portfolio, there is X $1,000 of dividends being reinvested.
Yeah.
It's almost like I almost view it as somebody is basically paying me or adding money to my portfolio on my behalf.
Yeah. They're paying you to invest.
Yes.
For you. Yeah. That's pretty cool. So like, is it, I don't remember what I was going to, never mind. I don't remember what I was going to ask. So, but I did like that you said you've been doing this for so long and that you track like the very small steps, because I've said this analogy a bunch of times, but like when you look at a 6-foot ladder, there's not a 6-foot ladder with the ground at the bottom and then the step at the top. So your goal when you started was like, hey, I want to eventually retire off these dividends. Imagine if that was your only goal. You'd still be working at that for the last 30 years and you'd have no like, yay, I did it, like progress, pat on the back moments. And that's, I think, the importance of like when you look at a 6-foot ladder, there's a step every 12 inches or whatever in order to make the ladder usable. And I use that analogy all the time because it's the same way in dividend. It's really the same thing in anything in life. But with dividend investing, you need to have those small victories that you can, latch onto and feel like you're doing something and you get remotivated and you know that it's working and you can get to your big goal.
Well, to help with that, I actually used to write it down in a notebook, and now I do it in a spreadsheet where every single month for the last 25 years, I've put in what's the portfolio volume and what's my predicted annual dividend income. And I've been recording that literally every month in a book for 25 years. And when you see that annual dividend income number slowly growing, and like you say, at the start of it, it's tiny little incremental steps. And then I remember just seeing it grow from this month I'm getting, say, $87 in dividends. The first month it went to, now I'm getting $100 a month in dividends, was a massive motivational victory.
Yeah. And then you get to the point where you start averaging $100 because like you might have that one, like the 3, 6, 9, 12 months where like everything pays. So like that month might hit 100, but then the other ones might still be at 60. And then like that's a milestone that I'm getting to right now where it's like, okay, now every month consistently I'm over $100. And that's, like
that's going to be a cool feeling for you.
Yeah. Yeah. It's just a bunch of little things where, and there's always, especially if you end up being nerdy with like numbers and spreadsheets like I am, and it sounds like you might be as well.
Yes.
Like there's always something that you can track. Like whether, like when you talked about your projected annual dividend income, the PATI, it's otherwise called, you can look at it yearly. I know some people do it, like I do it yearly, monthly, and daily. Some people do it by like a 40-hour work week. Some people do it, and you can just break down all these numbers. You're like, oh my gosh, I hit $1 an hour for a 40-hour work week, or I hit $1,000 a year for my projected, or I hit this. And like you can always find a number to give you that little spark and motivation when you need it, which I think is super cool.
Yes, for sure. I mean, I actually have it in, like you've just described, I take it all the way down. I've got yearly, monthly, daily, hourly.
You don't have seconds?
No, I don't have seconds yet. But after this conversation, maybe I will go away and take
just for fun. Yeah, it'd be cool. Like every time, like when you put something in the microwave or something, you're like 60 seconds. But I'm gonna make 6 cents in dividends while this is cooking in the microwave. That's pretty cool. So yeah. Okay. So you have the same goal as I have, is to eventually use your dividend income to replace your regular income, like your working income. So my question for you, and you might not have an answer for this, or you might, is when will you know when enough is enough? Like, is there a certain number as far as like a percentage of your income? Are you trying to get 100% of your income, 150% of your income, or how are you handling that?
I would say, well, I know how much I spend roughly because the dividends is only one side of it. It's obviously income, spending is another side. I'd say I would say a comfortable, relatively frugal life. Like I don't need fancy stuff and whatever. So I would say, and a lot of it's taxation related. So if I was to replace 60% of my salary with dividend income, and it might be different in the States because of how tax laws work up here, the net amount landing in my account would be more. Even though it's 60% rather than 100, because of how dividends are taxed and salary is taxed, my net would actually be more. So that number, 60% to me, would be a nice number because it would not only replace what I was netting from my job, but it would give me a little bit more as well.
Yeah, that's actually a real, I've never even thought of that because like I've always been, so my strategy is I want to get to 110% of what my expenses are for the year.
Yeah.
So if I spend $3,500 a month, whatever that is times 12, I don't know, but $3,500 a year, or that'd be nice. $3,500 a month times 12. I want to get to 110% of that because in that $3,500, what the wife and I do is we include what we invest per month and what we save per month. So in theory, if I can get to 110% of that, one, it accounts for inflation and all kinds of different stuff and weird one-offs. And then two, it's also keeping the lifestyle that we're still adding to the portfolio with that money and we're still saving money with that money. So like that's my approach, but your approach is kind of cool to think about, like the whole what you make versus what you actually bring home. What you bring home is what you need to replace, not what you make.
So I will say the approach that you just described with your wife is exactly what I used to do.
Okay.
So that was my original approach. It was all based on expenses, and then once I hit that as a goal that now I've gone past that, then I switched my goal to this. Let's now move it to replacing my income because, as I said, because my lifestyle's not overly complex, I know what my base cost of living needs to be.
Yeah.
So I was saving a big chunk. So the route you're going down, I think, is a great route to do it, and that is exactly what I did at the start of my journey. And then once I hit that goal, I just adjusted my goal.
Okay, so that's kind of the premise of the question: is the adjusting of the goal. So do you see yourself when you hit this next goal? Is there another adjustment coming, or are you actually at the point where you're like, hey, this is the final destination. This is my goal. This is where I'm done.
I would say that I subscribe to the concept of enough, not just in dividend investing, just in life in general. There has to be a point where I feel you're satisfied with what you have, and you can sit back and enjoy it, as opposed to just constantly chasing the next thing. So I want to get to a point where I have enough that my golden rule behind this whole thing has always been to get to a point in life where if I've had it with my work, I can just say to my boss, I'm done with this, and just walk out. Mm-hmm. That to me has always been the concept of why I wanted to come down this dividend model. So it's more about achieving a point where you have peace of mind.
Here in America, we call that FU money.
Yes. I guess we don't tend to use the F term as much up here.
Yeah,
so it's more, I'll just tell my boss where to go and I can leave. And that was to me, that was the biggest milestone of all. Because now it gives me the flexibility to pursue other things. I'm still working full time because I think what I do is pretty rewarding in my job. But if I needed to, I could just say, I'm done with this, walk out and leave, and move into other areas.
Yeah, that'd be cool. I mean, at the end of the day, like that's why most people do. Like I said, some people do dividend investing just to have an extra $3,000, $4,000, $5,000 a year that they can use for vacation, and that's perfectly fine. And then you have the other people, like yourself and me, or me and you, whatever the appropriate way to say that is, like both of us, where we want to use it as the source of our income. And like it's just the financial independence is what you're looking for. Is like to the point where like you could still work. Like maybe you get a really good boss and you're really loving what you do and it's still rewarding and you want to stay there. Like you have the flexibility to do that. If you wanted to do it part-time, you could ask about that just so you're, not sitting around doing nothing all day or whatever, or you could just fully quit and you're done from there. So that's really what the big goal is.
Look, the thing that I noticed as I went through the journey, it's even though the goal can be to get to that point. So you don't, like you say, you don't even necessarily have to quit your job, move to part-time or whatever. Just the peace of mind of knowing you now have those options.
Yeah.
that makes a massive difference.
Yeah, I agree. Yeah, and it's the same thing with like I don't subscribe to this theory, but the same people say about like paying off your mortgage early. And I know in Canada you guys have a whole different structure for your mortgages that I don't want to be a part of. But so I have a 30-year fixed and my interest rate's 2.75%. So like it's very low. And I know some people that still subscribe to the theory, just like you're saying, it's about the peace of mind, not necessarily the money like gained or lost by keeping or paying off that early. And they'll do the same thing with their mortgage where they pay it off early and they're like,
Yep.
yeah, it's the peace of mind of like not needing to pay a mortgage. I'm like, yeah, but you still have real estate tax or you still have property tax and all kinds of other stuff in homeowners insurance, stuff like that. But so yeah,
what you just touched on was something that triggered my investing journey. So my initial goal was to pay off where I live. When I first bought my place, I tried to pay it off as quickly as possible. And then as soon as I paid it off, everything that was going against my mortgage then went into overdrive and buying these dividend stocks and investing stocks. So again, this is what we talked about, the changing goals as you're going through this journey.
Yeah.
So again, my initial goal when I first started wasn't necessarily growing my income. It was to let's pay off my property, get that out of the way, and now I'll go full steam ahead.
Mm-hmm.
My income.
Yeah, and people, yeah, I mean, that, like I said, there's so many different paths for that because some people, like Chad, my very first interview, we were talking, and at the time that we were talking, he was a big proponent of like keeping, not necessarily keeping some debt, but he believed that like debt was like part of the American society, so you're never gonna not have debt. So he was like, you're gonna have debt, but he goes, don't not invest also. So he was like debt and investing at the same time. Which, it's not how I jive, but just because it's not how I do things doesn't mean it's right or wrong. So he was doing that, and I think he's since pivoted on that. So some people get all the debt off and then hyperdrive, and then his idea behind it was if it takes you 3, 4, 5 years to pay off whatever the debt is, 10 years, whatever it is, you're missing out on those years of compounding, which is true. But then the people would hit it from the other side, like you were saying, of but then you can take all that money and you can like catch up and then some kind of thing, in theory.
But this is where I think the whole concept of not being mirrored to one strategy. So in the example you gave, whilst originally I was all about paying my mortgage, I wanted that debt to go. When the pandemic hit, I took out this massive line of credit to buy income stocks. Mm-hmm. But I still have a I'll call it a relatively significant piece of debt, but I don't worry about it at all, because the income that my stocks are generating is not only covering my interest payment, it's also paying down that line of credit. Mm-hmm. So that's definitely something that I've learned in my investing journey. Don't be afraid of, as long as your comfort level is there, of taking on debt to grow your income streams, mm-hmm. I would say. And I know that's not for everybody, but it's the same company that a company would do. If it was a regular company, organizations take on debt all the time to grow their businesses, etc. And I see the same principle for individuals. But if someone had said to me 20 years ago, you're going to take out a $300,000 line of credit to buy stocks, I said, there's no chance that will ever happen in a million years.
Yeah.
And then when it did happen, it's like, this is perfectly fine because this side is bringing in more than enough to pay it off.
Yeah. Yeah. That's a cool way to. I mean, at the end of the day, exactly what you're talking about is like when you go get a mortgage, like you have to use leverage. Most people, if you're going to buy a $300,000 house, you just don't have $300,000 laying around. So what do? You might have $50,000 laying around, and then you go to the bank and you borrow, you leverage money, and say, hey, here's my credit, here's my job history, here's all these things. Do you trust me enough to borrow $250,000 to put towards this house? And then you hope that over the years you can, 1, pay it off, and 2, that asset appreciates. It's just looked at completely differently. They're completely different on the stock side of things, and it's literally the same thing.
Well, one of the things that's beneficial up here, and I think your system's slightly different, is money that we take out to invest is all tax deductible, the interest on it. So a mortgage up here is not tax deductible. But because I took out my cash and I've invested it in stocks, I can deduct all that interest. So that, as I mentioned earlier, that's a part of the investing journey that I'm not sure everybody fully realizing what's tax deductible, what's taxed favorably, what's not taxed favorably I think that's a gap from a lot of people that I've seen.
Yeah. Yeah. I think, don't quote me on this, but I feel like ours is the
I
opposite
don't need
way.
to quote you. You're on a recorded
Yeah,
video.
yeah, yeah. Nobody quote me on this. Actually, yeah, this is off the record. I actually
Yeah.
think I think in the U.S. it's actually the opposite because I know I can write off
Yes,
my interest on my mortgage, but if I and to be fair, I've never gotten
it
a
is
loan
the
on
opposite.
loans. Yeah, so like we do interest. I know because I have a mortgage. I've wrote off my interest on my taxes, but I've never borrowed money for stocks, but I don't know that you can. I mean, I'm sure
No,
somebody else knows.
but that's the essence of the point. I agree. I think it's the exact opposite
Yeah,
in the US to what. But the question is, how many people actually know that
yeah,
and take advantage? Like if I asked, let's say I lined up 10 Canadians on the street and said, "Did you know that
yeah.
money to invest in stocks you can deduct your mortgage? You can't." I would bet 70% of them would not know the answer to that
Yeah, I
question.
feel like you're being generous with that 70% too. That's the amount because at least here in the U.S. the amount of people that like don't even invest. I think it's like 52 or 58% of people have some sort of investment, but that's including like 401k, like employer sponsored
Yeah.
programs. And like most of them don't even know what that is. They're just like, yeah, I don't know. The work takes some of my money from my paycheck. Like that's all. That's the extent of it. So, which is again better than nothing. But okay, so I alluded to this earlier in the interview. So my next question is: do you have any specific criteria that you use when selecting your dividend stocks? And then if so, what are they, and like how have they changed? So one thing I like to avoid with this is I don't like to use the words like good and stable and stuff like that. Like I like numbers or I like criteria you could actually put numbers to. So do you have any of those?
That's a good question. So the answer is, I would say no. I don't have a criteria. My main criteria is I read a lot and I
Okay.
watch a lot. So I read a couple of the business newspapers up here, literally cover to cover every day. I'm sure you have Bloomberg TV. I
Mhm.
watch that every day. So most of my investment decisions are driven by something I've read or something I've watched or listened to. I don't you and then once I've listened or read about it, then I'll take what I've heard and maybe investigate it a bit more. But I'm certainly not going through, I'm not looking at price to earnings rate. I'm not going through lists of stocks and analyzing them. I don't do any of that. There was a time in my life when I did that and it was just so time consuming.
Mhm.
So now I fall into this strategy of I will buy the entire market, nice, easy income ETF, and then specific individual stock ideas. As I say, they're usually triggered by something that I've read or watched on TV.
Okay. Yeah, and I mean there's no right or wrong answer on there. I think personally that you need to have some kind of strategy that you can follow because what people commonly refer to it as like the dartboard strategy where you're just like, yeah, I don't know, there's a list of 10 stocks, I'm going to buy the one that this dart lands on. Like that's not a successful way to reach any kind of goal. So like you do need that, whether it's like you said, reading cover to cover on this and like educating yourself on why things may
Yeah.
or may not be good ideas, like that's a strategy. I personally have criteria that I have like because it helps me take the emotions out of it too. Because one
Yes.
thing I've noticed is like you can go to 10 different websites, you're going to have different websites saying here's what the bulls say, here's what the bears say, and like both can argue. That's what makes it a debate, right? Is that both sides are debatable. Like you can argue, like there's no such thing as like the sun's hot. Like people aren't debating that because it's like we know that the sun's hot. But like when you get into the area of like so and so is a good company, somebody might say, hey, yeah, you might think that, but here's my reasons why they're not a good company. So like you're educating yourself on that, the different points of view on different things. So I at the end of the day, I don't think there's a right or wrong answer. I just think that it is important that you do have a strategy that you can stick to.
Well, what I agree with the final point you just made, I think, is one of the key lessons I learned. Whatever your strategy is, be able to stick to it.
Mm-hmm.
For a lot of, like, for example, I've hit a point in life now where I simply can't be bothered to troll through all the numbers and analysis and whatever.
Mm-hmm.
So a lot of time my strategy is just keep it simple. I'm going to put 80% of my portfolio just plain index funds, watch it grow and whatever, and the other 20 I'll play on. But like you say, as long as the strategy is somebody is knowledgeable about the strategy and has the time commitment for it,
Mm-hmm.
then I'm 100%. But not every, yeah, it's a balancing act. Is how much time are you prepared to personally invest in looking after your portfolio is also going to drive it.
Yeah.
Not everybody has the time to look into everything.
Well, and that's kind of, I've brought this up in several interviews before, but that's one of the things that I like to really harp on and focus on, is that some people that are watching this interview might actually think that unless you have 3, 4, 5 hours a week to focus on this, you can't invest. And that's not the case. And that's kind of what you're going on about, is like, you can decide to spend a lot of time if you enjoy that, but there's also a path of least resistance where you can spend a little bit amount of time, and a little bit of time when you can do like ETFs and stuff like that on broad-based index funds, and you can still get invested. You can still have your money work for you, and you don't need to spend hours a night with the little lamp on you and just really looking at all these numbers. Like, there's different options for everybody.
And that's what I always tell my friend. The vast majority of people just go with something basic, index funds, whatever, and buy a nice ETF. And we have a lot of them in Canada. I'm sure you have in the States. We have a lot of dividend income focused ETFs. It just gives you a broad basket of 50, 60 dividend paying companies. You don't really need to worry about them. So it's still following the goal of income dividend investing. It's just you don't need to get into the mechanics. I mean, the reason I read like cover to cover and watch my TV is, for me, investing's now a hobby, for want of a better. It's not just about generating income, growing the portfolio. I just find the whole concept interesting.
Yeah, I agree. I agree with that. Okay, so I always like to hear the response to this one. So what, like, how important do you consider staying diversified in your portfolio? And then what rules do you use to help make sure that you are diversified? You're not over diversified. Do you believe in over diversification? What do you think about that?
I believe diversification is very important, especially when a particular part of the market has got overvalued. So, for example, I know there's a lot of talk about the Magnificent Seven in the United States and whatever. Don't get me wrong, the Magnificent Seven might just explode and launch everything, but I've definitely hit a point whereby, wow, this is getting to a point if you've got too many apples in the same basket.
No pun intended.
And I definitely hit a point of that. I think everybody has a bit of domestic home bias. I definitely hit a point where I had too much of my portfolio in Canada, and probably too much in the United, and I'd excluded external to North America. So I believe diversification is crucial, but I also believe that it is too difficult for a normal person to know what is going on in all of these geographies all over the world. That's where I see the split between individual stocks and dividend investing and just general, like everything that's outside of North America, I'm all in ETFs. I don't own individual stocks. It's just, here's my Europe, here's my Asia Pacific. And then in North America, it's more, I do have ETFs, but it's a lot more individual stocks as well. So diversification across industries, regions, sectors, I think it's massively important.
Now, do you believe in what some people call over diversification?
Well, there's different definitions of over diversification. Are you talking about when it gets so complicated that they're constantly trying to bring it back into balance?
No, more along the lines of, like, I know some people, so here in the US, like, obviously the S&P 500 is a big thing, right? So, like, you'll have some people that have this index fund that primarily tracks the S&P 500. This one, some people actually have like VOO and SPY, which are literally the same thing. But then other cases, they'll have like this ETF and this ETF. And when you pull it up on like the ETF overlap tool, they're like 97% the same ETF, even though they say that they're not directly tracking the same two things. The companies that they end up holding are the same. So like, and then on the flip side is, if you're not using ETFs, there's some people I know that might have 70, 80, 90, 100 individual holdings instead of an ETF. So like, what are your thoughts on those two things?
So yes, I've seen that a lot as well. So if I've got my US S&P 500 ETF, I'm just going to have one. I've selected whether it's Vanguard, iShares, whoever it happens to be. I'm not going to have two, which are covering exactly the same thing, because that's classed as diversification. Because it's not. It's like you say, it's exactly the same product. Look, maybe one's got slightly cheaper fees, whatever. But yeah, I'm one product typically for one investment market. I look at it from geography, I look at it from sector, and I look at it from market capitalization. So in terms of your S&P 500 one, I would also have a small cap ETF to balance it out as well. But yeah, this whole, do I need, in terms of, do you need an ETF or individual stock? Again, I think it depends on how much do you know about the individual stocks in the portfolio. So for example, because I'm up here, I tend not to know as much about the US companies because I don't see them in news all the time. I'm not reading about them. So for US, like obviously I know my Microsoft, my Amazons, my Morgan Stanleys, whatever. But after you've got outside of, say, the top 20 companies in the S&P 500, from 480 down, I probably have no idea what those companies are. I couldn't describe what they do. So I'm certainly not going to look into buying individual stocks in those. I'm going to let my ETF handle it because I don't have the time to look into them all.
Yeah.
But if I do have time, that's when I make the decision to go individual stocks.
Okay.
So I think for most people, I think it's a good idea to get a broad swath of everything in an ETF.
So if somebody was allergic to ETFs, what would you say is like, I mean, obviously this varies from person to person, but like, what would you be, pretend you couldn't own any ETFs and you could only own individual companies in both the US and Canada. What would be a number of stocks that you're comfortable for or comfortable with? I know some people say that the range is between 20 and 30. Do you subscribe to that? Are you less? Are you more? Where do you stand?
So if it's so let's use North America combined, like you said, Canada and US. I think for a diversified portfolio, I would say probably 30 or 40 individual stocks, just because because I would look at it from sector perspective. You've got like healthcare, technology, energy, financials, whatever. Let's say there's 10 official.
I think there's 11.
Yeah, 11. So yeah, I think if you've got 4 or 5 in each sector, to me, that's a good balance, which brings you out at around 50.
Yeah. My most I ever got up to was 36 individual holdings and 3 ETFs. Now my ETFs was like, I think I had SCHD, VOO, and I forget what the other one was. But then I'm down to 11.
Yeah, I'm similar. Like, as I say, I've got certain Canadian companies that I know very well, certain big players in the US, but the vast majority of my portfolio now is in ETFs.
Yeah. My whole Roth IRA, minus one holding, my whole Roth IRA is ETFs. And then my individual portfolio, the one that I track on the channel, is all individual stocks. And I don't know, and maybe you can actually shed some light on this. So like if you're building a portfolio of individual stocks, like at what point do you consider I know some people refer to it as like a full position or a partial position. Like in my case, I'm adding, I have 2 holdings that are over, I just hit $5,000 in each of them. And then the other ones are somewhere between like 3,700 and less than 5,000. So like at what point, and this is, I don't know, this isn't really rhetorical. I'm just genuinely asking from my point of view of like, at what point do I consider looking into a 12th stock? Like, do I have to wait, or in theory, do I wait until all of them are at least at 5,000? Like, is that a full position or is it more than that? Like, what do you think?
Well, I don't look at it in terms of dollar value. I look at it as percentage of your overall portfolio.
Okay.
So for example, I think the 5,000 number was based on a portfolio size of $100,000. So it was a 20th. I think that's where that number, I don't know for sure, but that's where I think it came from. So I look at it from, if this is more than 20% of my overall portfolio, then I'm probably overweight in it. I don't subscribe to the number philosophy, like the 5,000, 10,000 one. I always subscribe to the what percentage is it of my overall portfolio, because then it applies to everybody.
Yeah.
Like if you've only got $1,000, by default you can't have a $5,000 position in anything.
Yeah. Well, yeah, and like mine, so I wasn't even like trying, so I just add to them. And the hard part about that is I know a lot of people say that you shouldn't have individual positions over 5%, But when you don't have 20 holdings, you literally can't have things under 5% because that's how it works. I mean, I guess you could have
Well,
70% in one and 1% in another one. But like,
that's where I subscribe to the essence of, well, if your portfolio is just getting started, in order to diversify, the only real way you can do it, I think, is through an ETF.
yeah, yeah. I like that. And yeah, right now I'm just trying to figure it out. Like, it's one of those things where I'm just like letting it go. Like right now I have my 11 positions. I have a strategy which I call the active and dormant strategy. The dormant positions are kind of like what you were saying, where like you don't let those drip and you decide whether you want to add to those. So it's kind of that strategy. Mine is I only drip those. So like I have mine is Starbucks and ExxonMobil are my two that they didn't meet one of my criteria that I select, which is my most important criteria. So I just have those dripping. And at a later point when I reevaluate, if they become meeting my criteria again, then I can turn them back on and I can start adding new capital to them. So of my 11 positions, only 9 are what I consider active positions. So I'm adding money to them. But
I was going to say, one of the other dangers, I think, of having, let's say, a 20 stock portfolio, I'm not referring to you because it sounds like you've just explained what your overall strategy is. Mm-hmm. If you've got a 20 stock portfolio, then I think it becomes a lot more difficult to make a decision as to which one should I add to and which one should I sell. Mm-hmm. If you have an overall ETF that suddenly covers, let's say, all 20 of them, you're not making this individual stock decision. Because the term I always use is analysis paralysis. Yep. I've seen a lot of people, and it's like, oh, I've got 20 stocks in my portfolio. These two are both not doing quite as well. Should I sell A? Should I sell B? And they're almost crippled by indecision.
Well, I mean, the hard part with that goes into like, I mean, I'm not necessarily facing that, but I've had that thought that other people have this thought where it's like, okay, in that position, you're in 20 stock portfolio. If you have a stock that's doing very well and it's now becoming quote unquote overweight, there's always a saying and then a counter saying. Like the sayings literally always contradict each other. So like some people will be like, oh, well, you have to take your gains, right? Because that one's winning. It's now overweight, whatever. Take your gains. Don't get greedy, whatever. But then some people call that like trimming the flowers and watering the weeds. So like, okay, this position's really small. It's really beaten down. But do you add, to your point with the informational paralysis or analysis paralysis, is like, do you add to the position that's not performing well because it's a good time to buy and you can buy low, and if it does perform well, then you're good? Or do you keep adding to the position that's actually giving you fruits of the labor that you're putting into it? And it's kind of one of those things where you just kind of beat yourself up like, which one's the right answer?
But this is where I feel it's important, and this is one of the things I've learned, is to have every individual tip, but your own individual investing philosophy. So let's say, for example, it's a 20 stock portfolio. So at the start of that, when the decision was made to have a 20 stock portfolio, somebody's obviously made a decision of, I don't want to have more than 5% in any individual position. Mm-hmm. So at the point in, say, let's say Nvidia or whatever has now become 12% because it's grown, there's a reason why you had that initial 5% cap. So unless you've changed your rationale as to your 5% cap, you should be default trimming it to bring it down to 5 again.
Well, I know. So in these interviews, not to cut you off, but in these interviews, I've actually had some people say that they don't do the trimming, but they'll turn it off where they no longer add new money. So instead of trimming, they'll just bring everything else up. So by default, Nvidia comes down.
And that's fine as long as regardless if they're trimming, adding money to other things, as long as it's getting back to balance with where they wanted their balance. There's no right or wrong answer. My concern that I see often is people say they want no more than 5% in one equity, and then they let something completely write up, so it's now 40% of their entire portfolio. Yep. They've completely thrown their initial plan out of the water. Yep. And then when that company hits one bad earnings report, suddenly it plummets.
Because now they're not diversified.
No. Yeah.
Yeah. Well, I mean, you see that in the group that we're in with like people now with like everybody's on all these REITs because the REITs are so beaten up. And then you look at their portfolio and they're like 46% realty income. I'm like, what? Like, I'm pretty sure that wasn't the plan. Like, that's not how you started. So yeah, I agree with that. I mean, it is scary because like that's how like the point of diversification is to mitigate risk, but then people just go down this path of like they keep adding to something that's quote unquote beaten up, or maybe it's doing really good and they want to keep adding to their winners, but they don't follow that original plan like you were talking about, and that's dangerous.
I mean, that's certainly a piece of advice I would get to everyone. I tend to do it now. at least every quarter, I sit 15 minutes just to see, is my overall portfolio still relatively in balance in terms of sector geography as where I hope it should be, and maybe make a few tweaks. There has been times in the past, and I have been burned, where I didn't look at it every quarter, and it was actually the REIT sector that got overvalued, and then it all collapsed, and I lost a lot of money because of doing that. Whereas if I'd have looked and kept it in my plan, I'd have been a lot better off.
Yeah.
But you live and learn.
Yeah, well, and that's one of the first questions I ask you is, more importantly than the mistake you made, is like the lesson learned behind it. Because like the thing that'll get you in life, and this is one thing that I've learned, is not necessarily the mistake you made, but it's when you make the same mistakes multiple times. Because clearly you didn't learn the lesson. The mistake, like the point of this series is for people to learn from your mistakes and learn from my mistakes, so they don't need to make the mistakes. But I also realize some people don't care about your mistakes. They don't care about my mistakes. That won't happen to them. And then when it does, inevitably, because it'll happen to all of us, the idea is, one, it happens early when they don't have a lot of money. Because like right now, if you were to make the same mistake you made earlier in your journey, it would cost you a lot more money than it did when you made that mistake. So that's the idea, is you make the mistakes early. And then the idea behind that is you make the mistake, and the mistake is the thing, but the lesson is what you take from the mistake. So that's very important. And like, it sounds like you did that. Like, it wasn't like, oh, it was just bad luck or bad timing or whatever. Like, no, you realized what happened is you didn't reevaluate your diversification that you put in place for a reason. And now your mistake was it burned you because it came down. And now you fix that. Now you have things in place to make sure that mistake doesn't happen again. So.
And then one of the other biggest lessons that I've learned, and I've subscribed to this, there was a point where I was getting involved in kind of covered called ETFs and all of this kind of thing. One of the biggest lessons I've learned is, don't buy a product unless you know exactly how it works. Like how that dividend, whether it's a dividend, a distribution, or whatever it is, unless you fully understand exactly how that dividend is being created, does it have earnings to back it up, then I steer clear of that. So that is a mistake I've made in the past. I can remember I've had stocks in my portfolio. People have asked me, what does this company do? And I literally have no answer.
It gives me money. That's what it does.
I can tell them the ticker. I can tell them it trades on the US stock exchange, but I couldn't tell you at all what it produces, what services it does. It's just, so now I've learned, if I'm holding an individual, I should at least know what exactly this company does.
Yeah, you're doing more than just buying 1, 2, 3, 4 letters in a basket. You're buying a company, and you need to understand what that company does. Because at the end of the day, and we're investors, right? So what we're doing, quite literally, is we're saying, hey, Visa, I have $100. I think you can do something with this $100 to give me more than $100 back. I'm gonna let you have this or borrow it or whatever. That's quite literally at the basic level what investing is. So imagine if you were to give me money and you were like, hey, Troy, I'll give you money. Are you going to give me back more money? And I'm like, I don't know. They're like, well, when are you going to give me back money? I'm like, I don't know. They're like, well, what are you using it for? I don't know. You're just like, wait, I don't know if I want to give you money. Like, that's a bad idea. So it's the same thing with your investments.
Right. I like how you explain it. I explain it in a slightly different way. I always explain it to people of, you are now a part owner of this business, because that's literally what a share is. And because, like you say, a lot of people, I mean, they just see it as a ticker on a screen.
Yep.
But when I explain to someone of, you are now a part owner, albeit a small part, in say General Motors or whoever it is, then suddenly it's like, oh, now maybe I should be a little bit more interested because I'm a part owner of this company.
Yeah. Yeah. I mean, you don't even need to wear a suit or anything. You just,
you don't need to wear a suit.
But you do need to know what they do. That's a good idea.
I mean, I heard that there were some idiots who were thinking wearing a suit to come to a Saturday morning interview.
I know. Hey, I should have let it happen. I'm disappointed in myself. Okay, so we got 2 more questions. So this next one is hit or miss. Sometimes I get really good responses to it. Sometimes people don't really know what I'm talking about. So the next question is, are there any dividend-related myths or misconceptions that you hear on the interwebs that are just like, just flat out not true? So like one of the ones, my example one that I always give is like, dividend investing's for old people. Like young people shouldn't even bother dividend investing. It's not a thing for us. Like, are there anything like that where you're just like, I hear this all the time and it's just not true?
So one thing I hear often is that dividend investing is guaranteed.
Mm.
A dividend is not guaranteed until the quarterly results is declared and it's distributed.
Mm-hmm.
So even though you have a forward-looking yield, that is not guaranteed until each quarter the company declares, yes, we're paying it out. So that's something I've heard. I hear a lot of times it's like, oh, I've got this, I'm guaranteed to get this 5% yield. Well, no, you're not. You need to actually wait.
Yeah.
And the other thing that I hear a lot is that there's no point investing in dividends because the amount I'm going to get is so small.
Or that it comes out of the share price. And people always
Yeah.
say that all the time. And I'm like, I mean, it does, but also.
It does, but fundamentally it's coming out of the profits of the company, which they could reinvest and whatever. So yeah, the whole thing about, oh, there's no point in me investing in dividend stocks because my portfolio is so small, the dividend's only going to be, say, $1.50. So I subscribe to I can't remember the exact quote. It's like a journey of 1,000 miles starts with a single step.
Mm-hmm.
I can't remember who said it, but something along those lines. And as I say, I wouldn't have got to where I am in my portfolio now if I'd have never received that first ever dividend of, say, $1 or whatever it was.
Yep. I mean, I tell this story probably 1,000 times already on the channel, but like my very first dividend was from SiriusXM, which I don't know how they're doing. It was a free stock I got, and they paid me a penny. And that was literally what I have a YouTube channel on dividends and everything was just from that one single penny. It was just like, hey, I got an alert from Robinhood, who I was with at the time, and it sent me a thing that said SiriusXM paid you a penny in dividends. I was like, do I owe this to somebody? Like, am I supposed to keep this? Like, do I put this back for taxes? I was like, what goes on? Like, what is this? So it literally, like you're talking about, it can literally start with your very first dividend. You have to start somewhere. Yeah. The first step's always the hardest. You don't get, like we were talking about with the ladder analogy. Like, good luck. You have a 6-foot ladder, but it only has a step at the top. How are you getting up there? So you need those little steps, whether it's a penny, whether it's $1, whether it's $100. You need that first step in order to get wherever you're trying to go.
Yeah, for sure.
Yeah, I like that. Okay, so last question for you. This is the finale. So you are now 18 years old. You're in today's market. So you can't go, oh, if I would have known about Apple or Nvidia or whatever, that's cheating. So you're in today's market. What tips, advice do you give to your younger 18-year-old self?
The biggest tips I would give to my younger self would be to not overthink things and don't overtrade. So starting out, it would be diversify as much as possible. And I know it's a cliche, some low cost ETFs. Don't try to pick individual stocks, just something nice for the US, something nice for North America, something nice for Europe, just low cost, and just let it ride. One of the biggest things I think that I did when I was younger, so my 18-year-old self, was constantly looking at papers, news, whatever. Oh, here seems like a good idea. Should I invest in it? Should I not? That is something that I wish I hadn't done. I wasted a lot of time agonizing over decisions about should I buy this? Should I sell this? Should I do that? So it would be that. Just start simple, easy. Don't overanalyze it. Don't overthink it. And just let it ride and give it time. It's like the analogy is it's like a snowball going down a hill. Mm-hmm. Starts off very small. If you were to suddenly start adjusting it and tweaking it after it's gone a meter, you're not going to get that full snowball. But sometimes you just have to let it ride. So that would be my biggest advice that I would give my 18-year-old self. Just put it in, let it ride, and don't overthink it.
Okay, now because younger Paul has a lot of questions and Paul wants to know things, he now asks you the question, how long do I let it ride? Like, do I let it get to a certain dollar amount? Will I know when I'm ready to start picking individual stocks, or how do I handle that?
I would say to at least let it ride until you hit around $10,000.
Okay.
And then once you've hit that, you can maybe think about branching out a little bit. But even then, it would fall back to the caution I said for only invest in something, an individual, if you know exactly what it does, how its finances work. Don't just pick something. An 18-year-old Paul has done this. Don't pick something because you heard some guy on TV talking about it and it sounded cool.
Yeah.
Do a bit of individual research yourself just to check it out.
Yeah. I think Paul would like that answer. I think that's a good
He
answer.
would do, and if Paul had made that answer, Paul wouldn't have been burned as many times as he did.
Yeah, Paul would be done already if Paul listened to
Yes.
Paul. Yeah, I like that. All right, well, Paul, it's been a blast. It's been a pleasure to have you on the show. I hope you enjoyed your
Thank
time.
you.
It was a
No,
little
this
bit
was
over an hour, but I think it went fast.
Yes, no, this was a great conversation. I appreciate what you're doing, spreading the word, giving knowledge to people. It's great.
Yeah, I couldn't do it without people like you willing to share your story, so I appreciate it. So if you have anything to plug, anywhere people can find you, the floor is all yours.
I won't say I've got anything to plug at the moment, but I'll probably put a link into the comments later. And overall, for anyone out there on the investing journey, as I say, just stay the course. Your portfolio might seem small now, but incremental little steps and it will grow over time. And my overriding advice, and I know I stressed it before, is never invest in something that you don't understand.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.